This is our Forex blog for January 25th, 2011. One of the first things we do when we first start trading is look at the currency meter, find out which currencies have the strongest weekly and monthly trends, which ones have the weakest ones, and then really hope that today's longer term trends play out, because that's really the easiest trading. Sometimes the weekly and monthly trend are super strong and the currency goes down all day, because currencies can't go one way forever. If you look at a daily chart of a bunch of currencies, let's say with the euro, you'll see that most of them have been going up over the last few weeks. That's why the weekly and monthly trend right here is strong. The dollar is weak, obviously. So you're really looking, for some extreme weakness in the dollar, and then last night, a couple hours before midnight, looking to see which currencies stronger. Let's see how the euro was back then, last night. So I had a little bit of strength a couple hours before midnight, and then weakness came in. That probably wouldn't have been the best one. That is the strongest weekly and monthly trend. Let's see about the Swiss. So the Swiss was quite strong. The weekly and monthly trends almost as strong as the euro. So last night, before midnight, if you trade the Asian session, the dollar Swiss would have been a good one to focus on. Now here, last night, you can see a little pullback here. You might have gone short. It pulled back about 20 pips. You may have gone short here and the market went sideways. You can get out of the trade. But most of the time, the longer term trends, continue at some point during the day. You can see eventually this went down. The euro dollar tried to go up last night, failed at its high, pulled back to the lower containment bands, which are usually reversal points. Because the longer term trend's so strong, pretty decent place to buy, especially when you have a double top with less weakness the second time than the first time. Very high probability right here. Took it a few hours before it resumed its uptrend. But that's one of the things that you can do. Super strong currencies look to buy the lower containment bands. Super weak currencies look to sell the upper containment bands or fib targets on the way up. Let's look at some strength or weakness right here. The yen had a lot of strength here at 3. What was one of the weakest currencies? Well, earlier, the pound was pretty weak, and it was still weak at 3, and the weekly trend shifted down at 2. So the pound yen would have been a great one to look for sells in that time, around 130 to 2. Here's 130 right here. You can see it's underneath the hourly. We also have a narrow range pattern before. You might have gone short here, lost money, because this is one of our systems. Anytime a narrow range pattern breaks out when it's underneath the hourly, you look to sell that. So you would have lost there, broke down again right here, you got into that trade, and you're actually in for about an hour before the currency meter really showed that this was one of the best ones to be in, and it just took off. Now at the time, it wasn't that weak. Most of us probably would have exited at least half our trade here at the monthly pivot level, because it's a very high probability place for the trade to stall, and you would have trailed the remaining trade. This is one of those times where the second exit is significantly more than the first one. You would have made 100 pips more on the second. And look where it went. Right down here to our Fibonacci level that was predicted the night before. I spend 45 minutes every night putting these fib levels on here. And especially when a fib level's way underneath the lower containment band, it's usually going to be like just solid support. It's not likely to go underneath there. So once it kind of went sideways for a while and the weakness disappeared, you could have bought down there and maybe made about a 40 pip counter trend move. Anytime it's 30 to 50 pips or more underneath the lower band, that's what usually happens. Right here around 5, the Australian became weak, and it matches the weekly and monthly trend. So at 5 o'clock, what was the strongest one? Well, it was definitely the yen. The yen, the weekly trend's up in this one, whereas this one was down until about 4, and it had less weakness than the dollar. Anytime you find two currencies that both have strength, look in the past. Which one had less weakness in the past? Which one had more strength in the past? Well, this one never really had a whole lot of strength until back here, but it didn't have much weakness beforehand. So if it's starting to show some strength and the weekly trend's up versus this being down, at 3 o'clock I'm going to look for weak currencies to sell against the yen. And you already saw what happened with the pound, and the Australian showed some weakness here at 315. You could also have looked for some sells around 315 in the Australian dollar. Here's 315. Price is underneath the hourly. This one's not as good as the pound yen for one major reason. This fib level here is very likely to be support. It's only 20 pips down. So, plus we had a narrow range pattern right here. This is one of the reasons why you don't buy breakouts of narrow range patterns when you're underneath the hourly. Usually you don't have too much of a continuation trade. So around 3, if you're a really aggressive trader, when it failed to go above the hourly right here, went above the 10-day moving average, failed and came back down, you might have gone short. But a safer trade is when it pulled back here, rallied back up. You can see a lot of weakness on the way down, not much strength on the way up. This makes a very high probability trade, and it's not the best trade in the world because the fib levels are very likely to be where it's going to stall. 83 is your profit target. You're short here around 05. After the spread, you might make 12 or 13 pips on this. So therefore, because of that, it's not the best trade in the world. When it hit this fib level right here, you don't want to buy because the weekly trend's down. But after a currency goes sideways for an hour or two, it's usually likely to go lower. You might have sold this breakdown here. There's a lot of support right down here, the lower containment bands here. Your profit target's maybe 65. So you're risking 10 or 12 pips, maybe to make 15 pips. Probability-wise, this is probably 70% likely to work. It had a false breakout earlier, pulled back, went sideways. The weekly, monthly, and daily trend are all down. It's not the best trade in the world. The best trade in the world are those that are 60, 70, 80% likely to work, and very importantly, the next support or resistance area is 20, 30, or 50 pips away. When you have a high probability percentage-wise trade and a very high probability of catching 30 to 50 pips, those are the best trades. But, like is life, they don't come around as often as trades that are only likely to give you 10 to 20 pips. That's just the way it is. Accept it. Now the CAD also became weak around 5:30. It didn't have much weakness earlier and had a little bit of strength. The strength died out, and the yen was weak. So you could have also looked to sell the CAD yen. Weak CAD, strong yen, it's likely to go down. And this one also has the benefit of, tried to go above the hourly, and usually when they're above the hourly, they try to go up. When underneath the hourly, they try to go down. This one had a multiple hour sideways range, which you can see here showed up in the yellow NR7 inside bar, and then broke down here. Now, normally you would never, ever, ever sell right in front of a fib level. But you can see this fib level, if you were watching this last night, would have shown up. It readjusts itself every day. It would have shown up right here. This fib level got hit, and it bounced, and it bounced, and it bounced, and it bounced, and it bounced. It got hit many times, and it never went up. So anytime a fib level gets hit at least 2 times, and you can't get a bounce off of it, and it doesn't start a trend the other way, it's very likely to break through it. So when it finally breaks through this swing low, you'd want to go short. It's also narrow range pattern right here, breakout, and your profit target's probably down here at the next fib level. These fib levels, once broken, usually cause enough panic and selling that markets go to the next major support area. The first one was right here, 67, and then the next one was 57. So if you got into this trade, and you can see initially it didn't start off as that weak, it's kind of working its way down. You can move your stop over each swing high, and if it would have stalled here, you would have got out of the whole thing, but it broke down underneath there and kind of went sideways. You might have been out of your trade here at 45, but you're short up here around the whole number. So you made over 50 pips in that trade, and usually when you have this kind of weakness, the trend's likely to continue down, but it's already underneath the lower containment band. So if you take a trade like this, it's riskier. This is probably no more than 50-50. If it weren't underneath the lower containment band and somewhere up here, it's probably 70% probability trade. When it's underneath the lower containment band, usually price reverses underneath there. I mean, every once in a while you'll get a 50 pip move underneath there, but it's not as likely to happen. So if you take that trade and realize that it's riskier and it goes sideways here, you got to get out of the trade. You maybe made 2 to 5 pips, or you even broke even on it. Now here you have a lot of strength. However, the market has major resistance right here. This fib level was support all day, and so once a support level gets broken, it's very likely to be resistance. In a perfect day, this move up would have had very little momentum, kind of like this, and you would have been all over that. Not only that, but you might have even double your trading lot size. But because of this strength, you got to be a little bit careful. On a tick chart, you might have found a 5 or 8 pip risk entry, and your profit target's down here around 60. A lot of times fibs, if they're broken earlier, they either hit and find support or they go down again. You might have got every trade somewhere around 65. Not the most profitable trade in the world. Let's look at some charts and see the patterns here. Extremely weak And so once a currency goes up and fails to make a higher high, you can see yesterday it just fell like a rock. Once it breaks down underneath this low here, very likely to go lower. So it broke down, came up. You might have gone short right here. That trade didn't work. You would have lost money on it. Went up above the hourly, came back down again. You go short. You might have made 25 pips on there. And notice extreme weakness here. So you wait for a little bit of a pullback. You go short, and you might have made 25 pips on that one. This one is a much better trade than what I just showed you, because anytime you have extreme weakness, you want to sell a pullback. And if the pullback is above the lower containment band, it's a much higher probability trade. This only pulled back about 20 pips. However, 20 pips adds up. Here's a currency last night. You might have gone short because all the time frame trends were down. It really didn't go down too far, and you can see there wasn't that much statistical weakness. And so yesterday it kind of tried to go higher. It failed to make much of a lower low today. And once it goes back above the hourly, that's usually a decent place to look to buy. Keep in mind the weekly trend was down. It shifted up at around 4. You might have went long right here. And notice in this trade, the probability isn't the highest, but this trade has something going for it that some of the other ones earlier didn't, in that the next resistance area is all the way up here at 66, and then the fib level at 70. So if you bought this trade right here at 40, you have a very real chance of making 25 pips while risking only 10. High win versus loss reward ratios, in other words 25 pips potential profit versus 10 pips or less risk, is a good trade to take. And you can see it kind of worked its way up, pulled back, worked its way up. Usually what you want to do is put your stop underneath the low, and it worked its way up and pulls back, doesn't hit your stop out, move your stop up, comes down again, you move your stop here, and at that point you're really hoping to get out right here. But if it shoots through your potential profit target and keeps going up, if it's above the upper containment band, first sign of it stalling, you want to get out. I would have got out of the whole trade somewhere up here at 90. You're in this trade at 40, you're out at 90. You made about 50 pips, which is 5 times bigger reward than your risk. And one of these trades like this can get rid of a ton of 5 and 10 pip losses. So if you're in a trade and it just takes off, you hang with it. Notice again the explosive power right here. This is our trend explosion system. Normally you want to buy a pullback, but again, because it's above the upper containment band, it's about a 50-50. If you did take that trade and it went up right here, and you notice as it's going sideways the strength is less, you probably want to get out of the trade with maybe a 5 pip profit. It's not as likely to work. And that's why I usually don't take trades that are above the upper containment band, even after an extreme momentum move. One other reason why this trade worked is when you have narrow range patterns that break down and the longer term trends down, if it doesn't cause a big trend, it's really telling you something. Anytime a narrow range pattern doesn't cause a big trend, usually when it goes back up, it goes in the opposite direction. So it's a very high probability trade in the opposite direction when you see that.